Hello, ladies and gentlemen, and welcome to our interview with J. Richard Claywell. J. Richard is a CPA and founder of bizvaluation.com and a fellow host of the Litigation Speaks podcast. In addition, he specializes in business valuation and forensic accounting in the greater Houston area, and he taught at various educational institutes and universities and has been published in several publications. Richard, thank you for coming to our interview today.
Thank you for having me. I sure appreciate it.
Absolutely. It's my pleasure to have you and discuss this important topic to our audience. Richard, could you tell us a short story about your career path and what brought you to where you are right now, and what you guys do in your organization?
I'm a CPA, and prior to what I do today, I was actually controller of a public company. I left that and went to industry, which was a private company. We had 21 subsidiaries, and they bought and sold a lot of companies. So I got involved in that. They were deeply involved with oil and gas, and it was going downhill. The company eventually went bankrupt, but I left about 4 years before they did that. I got a call from an attorney, and he asked me if I could value an oil refinery. I knew how to do that. This was in 1985, and I've been doing business valuations ever since. And I still love it. It's just a lot of fun.
Yeah. In Texas, there's a lot of oil refineries, I believe. So.
That's right. That's right.
So you're never out of job, right?
Right.
No, out of work.
And actually,
Okay.
what's happened is this has been the focus of my practice. And today I'm the chairman of the board of it's called ICABS. It's an international organization, and what we do is we teach people all over the world how to value companies. So that is very interesting to do that sort of thing, and I really enjoy teaching.
Mm-hmm. Yeah, so of course it's very interesting, specifically for business owners and people who acquire companies. It's very important to know how to do this, right, and to trust the person who does it. So right. I hope we will have a very thoughtful conversation about business valuation, best practices, and some steps that people can take to mitigate fraud risk when they acquire companies. So Richard, can you tell us what is business valuation in general?
Business valuation in general is a process of looking at a company and trying to figure out what it's worth. And there are three basic approaches when you do that. And it's called an asset, a market, and an income approach. Most of the time you wind up using an income approach because you're looking at how much cash flow is a company going to generate and how much cash can I put in my pocket. Some people will do a discounted earnings. Then the question becomes, how much earnings can you put in your pocket? Earnings is just a number. So from my perspective, you need to go after what is the cash flow, because at the end of the day, that's what you put in your pocket.
Mm-hmm. So there are differences between some people do some estimation of multiplier revenue or earnings. I'm not sure, but there are so many.
That's called the market approach. And what winds up happening is there's been, I hate to call them studies, but people have gone out and looked at what those average numbers are. The problem with using those rules of thumbs or multiples, as a matter of fact, not to promote what I've done, but if you go out and look at my podcast, there's a podcast on using rules of thumb. What winds up happening is the data that's being collected, is that on a cash basis or accrual basis, and which one are you on? You don't know. Is it before taxes or is it after taxes? You don't know. There's a process called normalizing where you want to go out and take out the abnormal items that you've got, one-time events, things that are not going to happen again. Have they adjusted for that? They don't tell you, so you don't know if that applies or not. Those numbers typically are based upon an average. So if you are a better performer, then you're going to undervalue your company. If you are an underperformer, you use an average, then you're going to overvalue the company. So that's something to think about when you use the rules of thumb or multiples that they're typically called.
Mhm. So how a usual normal business owner can improve his or her business valuation when they prepare to be acquired or sell their company?
When you look at valuing a company, here's something to think about. It's the two primary items from my perspective. One is the cash flow that you're going to generate and the risk associated with that cash flow. The higher the risk, the lower the value. The lower the risk, the higher the value. So if you're thinking about selling your company, probably should either have a valuation or at least an assessment of what those company specific risk factors are. You want to identify the skeletons that you have in your company and where the risks are, and work on eliminating or reducing those risks. The more you reduce those risks, the higher the value of the company is going to be. So this is not a weekend project. If you want to do that, you probably would want to do this over, say, a 3 or 5 year period to change the company from where it is today to where it's going to be 3 or 4 or 5 years. A valuation analyst is typically going to look at 3 to 5 years. You want to look at least one business cycle, which is 5 to 7 years. So now you've got all these issues, quote, corrected. The buyer is going to go back 5 years. So you're not going to have all those anomalies that are out there. It's going to increase the value of the company for you.
Oh, interesting. So interesting. How can a business know when they are being taken advantage of by their CPA? Just to understand if we have to hire a lot of accountants. So it's for others, not some business owners don't understand this figure. So just to understand what the professionals can recommend.
When you hire someone to do the valuation for you or do the analysis to find out what the risk assessment is, you need to find someone that's got the qualifications to do that. Now, there's a qualification called Certified Business Appraiser. It was here in the U.S. It's been that designation has been acquired, so they're not issuing it anymore. But that and called the Master CBA, Certified Business Appraiser, are the two highest designations, period. The problem with using a CPA, and I am a CPA, when you go to school and you learn how to do the accounting, you don't talk about doing business valuations. I've taught a master level course at the University of Houston. It's an elective for people, so you're not required to take it. The problem is CPAs will read a little bit about it. You got an article here, you got an article there. They think they understand how to do this. In my opinion, they don't. And so when you hire somebody that really doesn't have a really good, strong designation, and I believe I've got an article out there on Litigation Speaks on how to find what those particular designations in. If you don't have that, then I think that the CPA or whoever you've got is floundering. They're out there just pushing paper, trying to figure out what's going on. And they really don't understand all the nuances involved with actually valuing a company.
So, can you share with us perhaps what are some common mistakes made during regular business evaluation process?
That's a good question. In my Litigation Speaks, I've got 20 plus articles so far, and all of those are, quote, common mistakes. They're not necessarily common mistakes, but these are the types of mistakes that people are making. One of the major mistakes, I believe, is when you do a discounted earnings or you do a discounted cash flow, a lot of people will stop at projecting at a 5 year time period. The problem is you're supposed to project until the earnings or the cash flows are stabilized. They don't check to see if it's stabilized. So that's an error. Another thing that a lot of people do is they will make the depreciation expense the same as the assets that you're going to be buying in the final year. And they typically make those two numbers the same. The problem with that is you have this thing called inflation. The depreciation expense is not based upon inflation. It's based upon what you actually paid. The new assets that you're buying has got inflation included in it. So you're mixing apples and oranges when you say they're the same thing. So those are two common errors that I see almost all the time. And I think that's from inexperience.
Mm. All right. So, and for going to further to another area like forensic account fraud, what are some of the ways that financial experts can determine when numbers have been falsified, from your opinion?
One of the things to do is to look at the revenue stream that you've got. How are those revenues being generated? One of the common fraud areas is if I'm a salesperson and I get a commission on the sales that I make, I will go out and record those sales at, say, at the end of 2021. Then what I will do, so and now I've got my commission based upon the year 2021. Then I will go out and say, well, for whatever reason, that is not a good sale. We've got to make some refunds on it. And so now, as a salesperson, I will come in and say, well, look, we need to issue a credit for whatever it happens to be. And so now I've created a false sales amount, which increases the revenues, which increases the profitability, which is false. Then I've got to return the money back to the salesman because he's received excess commissions that he's supposed to receive. So that's one of the common things that happens.
Mm-hmm. Interesting.
Another thing that we see, I'm actually getting ready to get started on a case for this, is on your expense reports. If you have employees, they turn in expense reports. The problem is it's really, really easy to falsify an expense report. When I was looking at one just the other day, one we'd already done, we're getting ready to start another one. And this is where on the expense report, this individual did some air travel, doing quite a bit of air travel. But what they did on the expense report, they would use one airline and say this was a reimbursement for, and here in the US, well, I guess we got them everywhere. You got Delta, you got American Airlines, there's a British airline sorts of thing, but they were US airlines. So what they would do is they would list airline number one, the date and the dollar amount of the flight. Then they would list airline number two, the same information, same date, same dollar amount. Then they're getting really brazen. They've actually listed airline number three with the same date, same dollar amount for the same person. So the question becomes, how did this particular individual fly on three different planes to go where they went to on the same date? So that creates the question back to management. You know, I can't determine whether the individual did it or not. I don't think that they did. But then you take it back to management. Say, look, here's the deal. We need to get copies of those. Were they out on business at that point in time? Are they paying for family members' tickets also? Or just, what's going on with that? So that's one of the things that happens. I hate to say a lot, but it's real easy to manipulate the expense reimbursement reports.
Interesting. All right. And so what are some ways that businesses can add value before be selling themselves, for example? Is it what are best ways for businesses to add value before being acquired? So just the tips, if you have some.
Yeah, one of the things to do, and we talked about the risk assessment earlier, and this is on what's called company specific risk. What can we identify for this particular company? What that means is, do we have any skeletons in our closet? What's out there that's happened with our company, and typically it's ongoing, that we really don't want to advertise to people. We really don't want the buyer to find out about it. You need to go ahead and identify those things and get them fixed as soon as you can, because if you don't disclose that when you're doing the due diligence, the other side is going to get it. Okay, well, here's one thing that you didn't tell me about that's probably a major deal. What else is out there that you didn't tell me about? So it just opens up a lot of problems if you don't do that. So you need to identify that company specific risk, what are the skeletons? Let's get rid of the skeletons, get that fixed, which will make the company more profitable today. And that way, when 3, 4, 5 years from now, you actually decide to put it up on the market, you've got those anomalies taken care of.
All right. And how, for example, another question. How can shareholders ensure that they are getting fair value during appraisals? Because normally they hire this CPA and want to have good appraisals. What are the best way to ensure this?
I believe the best way to ensure that is to get someone that has the appropriate business valuation credentials. There are some that are real easy to get. There are other ones, it's kind of like going to the dentist and getting your teeth pulled. It's painful to get some of these designations. Now, saying that, we have a report we're working on, and the expert on the other side had one of the, what I would call a lower level designation. They didn't read the agreements like they were supposed to do, and now they've been disqualified. So the client has, on the other side of this particular litigation case, has to start all over again, which is expensive to do this in the first place. So make sure that the individual is qualified, and talk to whoever's going to do this for you. Find out, just ask them, what are the various credentials that are out there, and how difficult are the credentials to get, and which ones do you have? And just make sure that the individual's qualified. If not, they're not going to pick up on all the nuances, and they're not going to give you the appropriate value.
Mm-hmm. Okay, maybe a related question. What actions can business owners take or management to mitigate fraud risk from your perspective?
From a fraud risk standpoint, I believe that the company should have internal controls. These are typically set up by their CPAs. If they're not set up by their CPAs, then they need to find a CPA that can do that for them. We as a CPA are usually pretty good knowing what those are. I would make sure that management follows those guidelines. You can go out there and set up all the internal controls you want to set up, but if you just put it in your drawer of your desk when it's done, it doesn't do any good. So management has to implement those controls. You probably should consider having a spot check, random checks on various topic areas. And I mentioned a while ago, we were just talking about expense reimbursement reports. Go out there and every so often go through everybody's expense reimbursement reports and let people know you're doing this. That way, if there's a better chance I'm going to get caught with my hand in the till trying to steal money from you, I'm probably not going to steal money from you because I don't want to go to jail. So do some random checks on what those internal controls are actually doing and are they actually working.
Mm-hmm. Okay, fantastic. So if we're summarizing, if someone who is listening to this interview would like to walk away with one or two major takeaways, what would that be?
I think the one or two major takeaways would be to find somebody that's really qualified to do this. The vast majority of people that do this kind of work have what I would call a lower level, less experience requirement, less rigorous exam process, and find somebody that's gone through the extra rigors to get that. And then look at the experience on how many they've done. We were helping a guy a number of years ago. He called me. He had, I think it was either 12 or 16 companies that he needed to value. And I got his name and phone number. I looked him up on the internet, and he had a fantastic website. And he said he'd been valuing companies for 4 years. Called the guy, and we talked a little bit, and he was 100% correct. He had valued companies for 4 years, so he had 4 years of experience. The problem was, he told me he only did about 2 a year. So over a 4-year time period, he's valued 8 companies. That's not the experience that you want. You want somebody that does this on a full-time basis. So if you take, there's 2,000 working hours typically here in the U.S. In a year, So if I've been doing this for 2,000 hours, I've got 1 year of experience. To be an expert, you're considered to have done full-time 5 years worth of work. That's 10,000 hours.
Wow.
So
It's
that's
a
something
book mastery from Jay Green. He's also said 10,000 hours. It's kind of mastery for a
that's
profession.
right. And I would agree with it. It's interesting because I was talking with an individual yesterday. When I got my ASA designation, you're supposed to turn in 10,000. I turned in 20,000 hours because I was afraid they're going to cut some away from that. But what's interesting is that the more you learn, the more you realize you don't know.
Yeah.
So I've been doing this stuff for 35, almost 40 years, and you're constantly learning. So somebody that doesn't have that experience level has got one of what I would call a minimal or lower level valuation. I don't think that they can do a very good job. So look at the qualifications of the individual and don't be afraid to ask, are you an expert? Yeah. Well, what's the definition? 10,000 hours. How many hours do you have? And another thing to think about is the continuing education that you have to have. As a CPA here in the US, we have to have a minimum of 20 hours a year with 120 hours over a 3-year time period. My CPE, continuing professional education related strictly to business valuations, is normally about 100 hours a year. So we're extremely devoted to trying to keep up with what's going on. So ask those 2 or 3 questions and find out where your expert fits.
All right, fantastic. That's were all my questions. Perhaps if I forgot something, would you like to add something to our audience that will benefit them?
No, I think that's a pretty good summary. I would just don't be shy, don't be bashful to ask. What is your experience level? How many of these things have you actually done? How many hours have you spent? And what are your credentials? If not, you stand a chance of having to get it redone by somebody else.
All right. Fantastic. Thank you, Richard, for your insightful interview. And I wish you a great success with your important jobs also as a podcaster and also as a business evaluator and also as an educator. And I hope we will be in contact with you for next interview, maybe in the next few months period on a specific topic.
Well, I appreciate you having me on. And if anybody wants to try to find me, if you want to send me an email and ask a question or give me a call, my email address is richard@biz dash or a hyphen valuation valuation.com. So it's richard@biz-valuation.com. My number in the US is 281-488-7531. So if you want to give me a call and ask me a question, you want to send me an email and ask me a question, I'd be more than glad to help you with that.
Absolutely. Thank you. We will add this information in our show notes so people can actually see it.
All right. Sounds great.
Right.
Well, I appreciate you letting me do this for you today.
Okay. Thank you.
Hey,
Bye.
you bet. Talk to you.